Unit 4. Economic Categories. This chapter is designed to introduce the concepts of economic categories, their classification and basic features to the learners. After acquiring knowledge from this unit, learners will be experienced in basic concepts of economic categories, able to identify the characteristics of economic categories and their basic classification. Accounting categories. Accounting categories and terms are defined by accounting standards. These are the principles and rules of recognition, measurement and classification of business events and the preparation and presentation of financial statements. Accounting standards are not static. They are being continuously complementing and changing, parallel to the development of accounting theory and practice. Cyprus is applying international financial reporting standards as accounting standards. Accounting standards represent a set of principles and rules of recognition, measurement and classification of business events and principles and rules of the preparation and presentation of financial statements. According to accounting standards, accounting categories include assets, liabilities, capital, revenue, expense. Each category will be briefly described below. A asset. An asset is a resource controlled by the company as a result of past events and from which future economic benefits are expected to flow to the company. Controlled by the entity means that it has an ability to obtain the economic benefits and to restrict the access of others. Past event means that the event should prevent the acquisition of an asset, like a purchase. Future economic benefits means that entity expects prospective receipts of cash. The following figure shows the key features of assets. An asset may be used individually or in combination with other assets in the production of goods or services that an entrepreneur will sell, exchange for another asset, use to settle obligations or divide among the owners. Assets are reported on a company's balance sheet, and they are bought or created to increase the value of a company or benefit the company's operations. An asset can be thought of as something that in the future can generate cash flow, reduce expenses, improve sales, regardless of whether it is a company's manufacturing equipment or a patent on a particular technology. One of the classifications of assets is based on their physical existence. According to this classification, an asset can be a tangible asset, intangible asset or cash and cash equivalents. According to the classification of the assets based on their lifespan or liquidity, the speed they are converted into cash, there are two types. Non-current assets. Current assets. Non-current assets are such assets with a lifespan of at least 1 year or longer. Current assets are expected to be converted into cash in 12 months or less. Non-current assets. A non-current asset is an asset that is expected to provide economic benefit to the company for more than 1 year. An entrepreneur uses it in his business. During usage, an asset is gradually wearing off and depreciating, but does not change its shape. Non-current assets are typically not very liquid. And because of their high costs, these assets are not expensed, but depreciated, or written off over a number of years. Non-current assets can be in the form of intangible assets, tangible assets, financial assets and loans with a due date of more than 1 year. Intangible assets. Intangible asset is a non-physical asset having a useful life greater than 1 year. This asset may be in a physical form and in the form of a contract, loan, etc. Intangible asset includes research and development expenditures, patents and licenses, trademarks, investments in other assets, goodwill and others. Research and development expenditures are expenses used for the research and development of new products and technologies, results of which are expected to be used for more than 1 business year. Patent is a set of exclusive rights granted to an inventor for the invention, which is a solution to a specific technological problem. The patent is recognized for the inventions relating to the product, process or application. When patent protection is granted, the invention becomes the property of the inventor, which like any other form of property or business asset can be bought, sold, rented or hired for a limited period of time. The rule states that it may not last for more than 20 years from the date of filing the application, after which it becomes a public good. A patent can be reported on the balance sheet under intangible assets only if it is acquired from others. License is the purchase of a permission, that is a license to use one's patented invention or a protected intangible asset. The time right to use or the right to produce a certain amount of product is determined by a license agreement that is legally regulated. Franchise is a right acquired by paying a fee for a particular business. It is considered to be a fixed intangible asset because as it is prepaid for multiple business years. Concession is a contractual right when one party grants another party goods or the rights of their economic usage and the other party pays the fee for those rights. Trademark guarantees the owner exclusive right to place on the market the products and/or services identified and protected by its recognizable sign. The trademark protection in Croatia, as well as in many other countries, is valid for 10 years, counting from the date of filing the application. The protection rights may be unlimitedly extended for periods of 10 years, provided that the application is filed on time, generally before the previous 10 years have expired, and that corresponding fees and charges are paid. Goodwill is the difference between the value of the company on the stock market at a certain time and its accounting net set of assets. It is an intangible fixed company's asset, which enables it to make a higher profit than the normal or classic profit rate made by another similar type of companies. Tangible assets. Tangible fixed asset is an asset that has a physical form. It includes land, construction facilities, plants and equipment, tools, operating inventory and transport assets, residential buildings and flats, prepayments for fixed tangible assets under preparation. Non-current financial assets. Non-current financial assets are shares in affiliated companies, loans given to other companies and physical persons for more than 1 year, interests accrued on those loans with the repayment date of more than 1 year, investments in bonds, deposits placed for a period of more than 1 year. Current assets. Current assets include inventories, receivable from customers, affiliated companies, employees, government expected to be paid within 1 year, current financial assets like securities and bonds that will be released within 1 year or less, loans receivable with repayment deadline of less than 1 year, given deposits for less than 1 year period, cash and cash equivalents. The figure shows the comparison between non-current and current assets. B. Liability. A liability is a company's financial debt or obligations that arise during the course of its business operations. Recorded on the right side of the balance sheet, liabilities include loans, mortgages, obligations towards suppliers, deferred revenues, etc. According to the International Accounting Standards, the liability is defined as the current obligation of the company resulting from past events. The settlement of those liabilities would result in the outflow of resources containing economic benefits. The following figure shows the key features of liabilities. Liability is the duty or the responsibility to act or do something in a certain way. Liabilities can be legally enforceable and can be derived from business practices. Settlement of the current liability can be accomplished in several ways: by cash payment, by transferring another asset, by providing services, by assigning of liability. According to the payment deadline, there are 2 types of liabilities. Non-current liabilities are those liabilities with a maturity of more than 1 year. Such liabilities are usually incurred for the purpose of acquiring long-term assets or refinancing of long-term assets that have not matured. Non-current liabilities include loans payable with the maturity date of more than 1 year from the balance sheet date. Current liabilities are expected to be settled within 1 year, counting from the balance sheet date. Short-term liabilities include loans payable with the maturity of 1 year or less, payables to suppliers, payables to authorities, taxes, social insurance, payables to employees, accrued expenses. The figure shows the comparison between non-current and current liabilities. C. Capital. Capital refers to financial assets or the financial value of assets, which is left to the owners after all liabilities are settled. In other words, it represents the accumulated wealth of business, constituted by its assets fewer liabilities. It refers to the financial resources that business can use to fund their operations like cash, machinery, equipment and other resources. In the limited liability company, capital is expressed as a share capital. The balance sheet is breaking down liability into the share capital, capital reserves, statutory reserves, revaluation reserves, retained earnings, profit or loss brought forward, the earnings or loss for the current year. Capital can be invested in several forms. Cash, by paying to a bank account of the company. Contribution in kind, by putting a plant, equipment, machinery, other supplies etc. into the company. rights, by transferring a patent, license or some other right into the company. There are two primary types of capital, debt capital and equity capital. Both provided these types of business with funding, but there are differences between them. Capital generated by borrowing it from a bank or financial institution is a debt capital. These obtained fundings will be returned back to the bank or financial institution, usually with interest. Many business owners prefer debt capital over equity since it does not force them to lose ownership of their business. On the other hand, debt capital can be more difficult to obtain rather equity capital, especially for a new small business, as banks may be reluctant to lend them money. Equity capital generated by investors acquiring partial ownership, equity, in the business, buying shares of the company. The main disadvantage of financing a business with equity capital is that the ownership of the company will be partially lost. However, at the same time, in such a case it is not necessary to repay equity capital. The equity capital of the company includes equity capital brought directly to the company by the owner's investors, earned capital or retained earnings. The earned capital is the result of the business activities of the company. It is the difference between income and expense after taxation. The profit that company earned after payment of relevant taxes can be paid to the owners of the company in the form of dividends. Managers of the company can decide to distribute all received profit between company owners or just a part of the profit. Based on the decision of the company's management, instead of being paid to the owners, the received profit earned capital can be transferred forward to retained earnings. Therefore, retained earnings are the profit that a company earned to date, less any dividends or other distributions paid to owners' investors. There are several ways to increase a company's own capital. By issuing of new shares, that new members are joining the company. By recapitalization, means by increasing the basic capital to the existing members of the company. Capital reduction occurs in the following cases. Current year losses. The payment of gains for the current year or retained earnings of previous years to the owners, that is the payment of dividends to shareholders in the case of the joint stock companies. The repayment of the stake from the basic capital to the investor who exits the company. Impairments from revaluation reserves of reduced value of already revalued long-term assets. D. Revenue versus income. Revenues are the assets earned by a company's operations and business activities. In other words, revenues include the cash or receivable liabilities received by a company for the sale of its goods or services. Revenue is the gross of cash flow, claims or other benefits arising from the regular activities of the company from the sale of goods, provision of services and from the use of resources of other companies that make interest on royalties and dividends. Revenue is measured by claims from buyers and customers for delivered goods and services performed, and by fees and merits resulting from the use of buyers' and customers' resources. Amounts charged on behalf of third parties, such as certain taxes, are excluded. Revenue recognition mainly refers to the situation when the income is recognized in the company's profit and loss statement. The amount of the revenue or income deriving from a transaction is usually determined on the basis of an agreement between the parties involved in the transaction. When there are uncertainties regarding the determination of the amount or the related costs, these uncertainties could affect the determination of the time of the revenue recognition. Revenue recognition requires that the revenue can be measured and that its final collection can be expected at the time of the sale or providing services. The real expectation of the final revenue collection does ensure that payment by itself. Where there is not possible with certainty to estimate the payment at the time of sale or provision of services, the revenue recognition is delayed. In such cases, it is appropriate to recognize the revenue only when money is received. If there is no uncertainty when it comes to the final collection, the revenue is recognized at the time of the sale even when cash payments are made in installments. Revenues are typically separated into the following categories: operating revenue, non-operating revenue or other income. Operating revenues. Operating revenues are generated from a company's main business activities, usually sales. A sale is an exchange of goods for cash or claim to cash. Sales are usually recognized by manufacturers, wholesalers, and retailers when they sell their inventory to customers. Rents. Rental income is earned by a landlord for allowing tenants to reside in his building or land. Rental contract will be concluded between the landlord and tenant to set details of the rental payments. Consulting services. Consulting services or professional services include income from providing a service to a client. Consulting or professional service income is usually recognized by law officers after providing the client with legal service. Non-operating revenues or other income. Other income includes all revenues generated by a company out of its normal operations. Example of non-operating income for a wholesale company. Interest income. Interest income is the most common form of non-operating income since most of companies earn small amounts of interest accrued by the bank on their bank accounts. However, if the main activity of the company is receiving and providing loans, then interest income will be recognized as operating income since it will represent income from the main activity of the company. Revenue and income are different accounting categories. Income can sometimes be used to mean revenue, or it can also be used to refer to net income, which is revenue less operating expenses. Therefore, revenue represents a company's sales of goods or services throughout its operation, and net income equals to the total company revenue minus total company expenses. Types of income include gross income. Gross income represents revenue after deduction of costs of sales. Net income. Net income is gross income after deduction of a company's expenses. Expenses. Expenses are the costs of assets used by a company in its operations to produce revenue. Expenses are decreases in economic benefit during the accounting period in the form of a decrease in an asset or an increase in liability that result in a decrease in equity, other than distribution to owners. Expenses are recognized in the income statement when the reduction of future economic benefits results from a decrease in assets or an increase in liabilities, and which can be reliably measured. This means that the recognition of expenses occurs at the same time as the recognition of an increase in liabilities or a decrease in assets. The main types of expenses are operating, financial and other expenses. Operating expenses are the result of the company's main business activity and their level depends on the volume and type of business. Operating expenses include all costs that are incurred to generate operating revenue, like sales of goods etc. Examples of operating expenses. Rent. Some companies, instead of purchasing a space to operate, rent a space from another company. These monthly rental payments are recorded as a rent expense in accounting books of the company. In addition, a company may rent equipment or vehicles. Salary costs. A company has to pay to its employees for performing operation in the company. Some employees produce goods, some perform administrative duties, and company pays all of them for their time and efforts. These payments are recorded as salary costs. Electricity, water, telephone expenses. These expenses are necessary for business operation. Advertising. Advertising expenses are incurred in order to promote a company's goods or services. These expenses are recorded as operating expenses since they help the company to create revenue. Financial expenses are the result of obtaining, using and reimbursing financial resources. Financial expenses include interest expenses on loans, exchange difference loss, fair value loss or impairment of financial investments. Other expenses are the result of unplanned downsizing of business assets or unplanned increase in liabilities. Most often they are the consequence of irrationality from the previous period or because of the influence of They do not result in new values and they do cause the decrease in business results. Business result. The business result represents the success of an enterprise expressed by monetary scales. Comparison between income and expenses reveals the financial results. When the income is higher than the expenses, then the financial result is positive, gain. The loss represents a negative financial result when the expenses are higher than the income. According to accounting regulations, the company establishes a net gain in the amount of difference between the established profit and profit tax. In the case that the established profit before tax is not sufficient for taxes and contributions, a net loss is established in the amount of difference between the amount of tax and the established profit. If before taxation a loss is recognized, before the taxation the amount of the loss is increased for the amount of profit tax, and a net loss is established. After determining the business results, and based on a written decision of the owner or management, the profit is distributed and the loss compensated. In the case of a loss in the business, it is reimbursed from reserves, retained earnings from previous years etc., in order to enable further business operations. When it is not possible to cover the loss, a bankruptcy proceeding is initiated, followed by the liquidation of the company. If a company is profitable, then this profit may be distributed to the owners of the company in the form of dividends. Investment advisor needs to understand the different economic categories in order to be able to talk about business investments. To read and understand the financial statements, plans, projects, etc., it is necessary to understand the concepts of economic categories and to be able to identify their features. Financial reports content. Statement of financial position. On the face of the financial statements will be shown the following amount: property, plant and equipment, investment property, intangible assets, financial assets, investments, biological assets, inventories, trade and other receivables, cash and cash equivalents, assets classified as held for sale, trade and other payables, provisions, financial liabilities, tax liabilities, deferred tax assets and deferred tax liabilities, issued capital and reserves attributable to owners, statement of profit or loss and other comprehensive income. Other comprehensive income is those items of income and expense that are not recognized in profit or loss in accordance with IFRS standards. IAS 1 allows an entity to present a single combined statement of profit and loss and other comprehensive income or two separate statements. Statement of changes in equity. Statement of cash flow. Notes.